This is Bob Anderson from Factory Direct Modulars. I've got special guest, Cookie. She's over here whining now. Anyways, I have a big 65-inch TV, and I showed the video of me and Mittens doing the last report. Cookie saw it. so I decided, okay, she got jealous. So I'm going to put her in this. Now I'm going to put her down, which means she'll probably go in front of the desk here and start snoring. Anyways, this is the April 2022 market update report. I got two general topics, and then I'm going to talk about this behind me. This being extremely important, especially your first-time home buyers. So let's talk about pricing again. Jesus. I have one factory that in the month of March had three price increases. It's just I could do a market update report just about every day, to be honest with you. Anyways, so were any of the three significant? Not really. Combined, yes. And the thing is that when I say significant, it's not the mind-blowing price increases that I used to get last year, but it is price increases. And I'm going to touch on a little subject with that for just a second. There used to be a line item on my invoices ever since January 2021, when we started to actually put line items on there for lumber and surcharges and things like that would be on the invoice as if it was going to be a temporary thing. So is inflation transitory or is it a mass reset? Well, my invoices no longer come to me with these surcharges and whatnot, lumber charges as a line item like they used to. They've now been rolled into the base price of the houses. So what that means is I don't think these prices are going away. So anyways, it's kind of complicated to explain, but I don't see this going away. So now, next topic I wanted to talk about is my system, my business model. I had every once in a while I do have some moments of glee still in this rough market, and one of those is when your business model works flawlessly. So about a week ago, I'm driving down the road going from job site to job site, and I get an email on my phone, and I look at it. It's from one of my lenders, and it says customer so-and-so's loan has been approved. And I'm sitting there reading it, and I go, I don't even know who customer so-and-so is. So I emailed the lender back. I said, I don't know who this is. Maybe you've informed the wrong builder. And the lender comes back to me and emails me back and says, oh, no, this is so-and-so. You built so-and-so's home and so-and-so's home. And this is the son. I'm like, oh, okay. So let me explain what happened. Because my business model is relatively simple, and we take care of our customers and try to provide a good service and a fair product. What had happened is 2 years ago, I built a home for this young man's father. A year later, I built a home for his mother-in-law. So what he did is he just turned around and followed the system and called the lender first, got his loan approved, and then he's coming to me to build him his house. That's pretty good, huh? So anyways, I was rather pleased in that respect. And then I was a little like, oh no, that means I got to build another house. And what I mean by that is, if you saw my report of saving his consumers, the middle class Americans, $260,000 plus over the street dealers that I did a week or two ago. pertained to ordering of homes within a 30-day window of 6 houses, which is 72 a year. I said in that video, I can't build 72 a year. Can't even do it. Can't even possibly do it. But it amounted to $260,000 in savings, which with the mortgage payments and a lot of that, it was $450,000 total, which I was very proud of. In the process of me getting ready to do this report, I had to clear off my board here to put this together, and I realized that in the next 30 days, I have more houses to order than I did that report on. And those are deals that are ready. Those are deals where, customers have gone through getting their loans approved or whatnot, and it's like, wow. I mean, that's just nullifying. Basically means in a 60-day period, I may be ordering more houses than we built all last year. This phenomenon of our business is not slowing down. But anyways, yeah. So now let me get to market report stuff that's important to you, the consumer. Me building a house is not important to you. What's important to you is, what's going on with your pocket, what's going on with your loan approval, what's going on with the things that impact your family on a daily basis, not me. So, I got a message from a lender that I've known for 20 years. She's not one of my approved lenders because she doesn't do this type of business. She doesn't service new construction. But I have a lot of respect for her. I've known her for over 20 years. And in the message, she said, be careful if you've got any loan approvals that are more than 30 days out because they may not be valid anymore. And what that meant was because of the interest rates that are going on. So quickly, let me step back and then let me step forward. Back when the cerveza sickness was going on, the Federal Reserve, in their grand wisdom, decided to print free money and throw it at the bond market. The bond market is the market where mortgages are securitized and sold on Wall Street. Banks themselves don't actually pay these mortgages. They don't have that kind of money. Instead, what they do is they fund the mortgage and they package them up. Over 90% of the mortgages in this country on a monthly basis. And so what they do is they package them up and then they sell them on Wall Street. And that's how they get their money back. And what they sell them for, the price, is what dictates the actual mortgage rates. It has absolutely nothing to do with Fed lending rate or anything like that. Nothing to do with that. So get that out of your mind. And some of you may remember in the past, I've said that that's how I got in this industry. I used to securitize loans at Oakwood to the tune of $150 million a month and sell them on Wall Street. So, anyways, so I'm very familiar with the process. So when the Federal Reserve stepped in, they started buying $80 billion of mortgage securities on a monthly basis, which drove the mortgage rates down even more to some historically ridiculously low rates that aren't even reasonable. So, what does that mean? Well, we got to the first of the year, and we all know about inflation, right? We all learned the lesson and just print money and throwing it out there. Oh my gosh, guess what? We have inflation. So, now the Federal Reserve is trying to stop this inflation. So one of the ways they're doing it is they're stopping funding these mortgage-backed securities, which has created a huge boomerang effect on the mortgage market and the mortgage rates. So let me explain the impact. And I just did a high overview that probably none of you needed to know. But again, it's the stuff going on behind the scenes by a bunch of idiots that don't mind that they ruined, your house. So here we go. December 31st, FHA. I used FHA in this scenario because that's the number one first-time home buyer lending program in the United States. So FHA loan for a $250,000 loan on December 31st. If you closed, you got about a 2.875% rate. if you had, decent credit, you were buying an off-frame modular home, single-family residence, not a mobile home, not an on-frame mod from Clayton. That's not worth even the mobile home. So anyways, so you got your principal and interest was $1,021. Your mortgage insurance was $177. Your homeowner's insurance is about $100. Your property taxes, for example, in the state of North Carolina, on $250,000 is $125 a month, which means your principal and interest total payment is $1,423. What does that mean to you? What that means to you is if your builder or if your mortgage person that did your pre-qual based it off of, the industry standard for FHA, which is 31% housing ratio, then that means you have to, as a family, have a $4,590 verifiable income to qualify for that mortgage, at that rate. So, Federal Reserve starts talking at the beginning of the year, oh my gosh, inflation seems to be out of control. We seem to have an idiot running the White House. In there we got inflation. So what are we going to do? Well, they start pulling back the money. All of a sudden we go to 3.875 by the end of February. $1,176. These things stay the same. $1,576 is the principal and interest payment that you would have on that same mortgage at the end of February. You have to have $5,084 of monthly family income to qualify for that loan. Now, where are we at now that the Federal Reserve has really pulled the plug on the $80 billion a month? We are at about 5% rate. Okay? That's a huge increase from over here. We've gone up quite a bit. So, $1,342. Same thing with these. $1,744, an increase of $321 in your principal and interest. Well, what does that mean? That means that you have to make more money to qualify for that same loan. $5,626, an increase of $1,036 over this person here to qualify for the same loan amount. Okay? An increase of family combined verifiable income. Okay? I bring that up for this reason and this reason only. Well, for two reasons. Number one is if you have a pre-qual, you talk to a lender more than 30 days ago, and you think that you qualify for $300,000 or whatever you think you qualify for, you probably want to talk to that lender again because you may not qualify for that anymore, given the current market rates. If that was the element that was in your debt ratio. If you own a couple cars and all that kind of stuff, and you got payments on those, it could be some other different number. But this is all being impacted right here for your housing ratio on that mortgage rate. $321 more, just on $250,000. Secondly, if you have a house in construction and you didn't get a construction to perm loan, which by the way, I highly recommend for all my consumers, and this is exactly why, so that they qualify. Even if these rates go to 10%, they're already locked in. They don't have to worry about that. They don't have to worry about the stupidity going on in this country. They're locked in. Their payment is guaranteed, whatnot. But if you're doing a two-close or your builder is building it without a construction loan, you may find when that house gets done, you don't qualify for the loan anymore. Okay? So, I bring that up because they're also in this industry. One of the things that a lot of these builders do is they send your application in, which again, why are you giving this builder your credit information? I don't know. But anyways, they send your application in. And here's the number one thing they say to that lender. Can you give me the max pre-qual? So let's say the max pre-qual based off of your income and your debt ratio and all that kind of stuff was $300,000. Well, that's what they were running off of back in November. It was $300,000. Not the fact that today it may be $225,000 because the rates have gone up 66%. 66%. Did you hear that? So, anyways, this is something important for you to follow up on or whatnot. I can only provide you the information, and you can only take it from there. Everybody have a good day, and good luck. And by the way, I am behind. I try to call people if I can. It's just ridiculous. Talk to you later. Bye.